Hello and welcome, everyone. My name is Jillian Bender Cormier. I'm head of culture with Bender Insurance Solutions. We want to welcome you to another educational Bender U webinar, Empowering Your Finances with Self-Funding and Captives. Some housekeeping notes. At the end of this webinar, we will have an engaging Q&A session that I will be facilitating. If you have any questions during the webinar, please feel free to type them into the chat box or in the Q&A section, and I'll share them with our speaker during that dedicated time. We want to be conscious of time, however, so if we don't get to answer all of your questions, we'll gladly reach out to you individually after the webinar has concluded. You are all in listen-only mode and will remain muted throughout today's session. This class is being recorded, and at the conclusion of the webinar, both the recording link and a copy of the slide deck will be forwarded to you. We have an incredible set of experts sharing with us this morning, but I'll let Josh Keller, our employee benefits broker, have the honor of making the introductions. Welcome, Josh.
Well, thanks so much, Jillian. I really appreciate it, and I want to say welcome, everyone. My name is Josh Keller. I'm an employee benefits broker here at Bender Insurance Solutions. And I'd also like to hand it off to my coworker, Keck, to introduce herself.
Thank you, Josh. I'm extremely excited. My name is Keck Royce. I've been with Bender for over 11 years, and I'm Vice President of Healthcare Risk, helping our clients strategize regarding their organizational exposures. And so I'm truly excited today to introduce our speaker, Brian Skaggs, Senior Stop Loss Specialist with Sun Life. He has been in the employee benefits industry for over 18 years and specializes in helping employers manage the risk of their self-funded health plans and helping fully insured groups make the transition from their current fully insured group to self-funded. He is a graduate of Cal Poly in San Luis Obispo. Go Mustangs, I believe, right?
You got it. You got it.
And lives with his wife, Leslie, and their 6-year-old daughter, Emerson, in the small farm town of Winters. Brian, I'm going to hand this off over to you. Thank you.
Great. Thanks, Keck. Hi, everybody. So Brian Skaggs with Sun Life. Very excited to be joining everyone today. I was just telling Keck before this started that the guy in that picture has a lot less gray hair on the sides than I seem to have now. So you can kind of tell that that's been a while. But yeah, so senior stop loss specialist with Sun Life Financial. My role is really we provide a specialized insurance product that helps self-funded groups minimize their exposure and cap their maximum risk on their self-funded plan. But really, what we're going to do today, we're not going to talk so much about that. But what I'm going to do is going to try to give you guys an overview on basically what is self-funding. So this is our introduction to self-funding and captives. So we're going to talk about, what self-funding is, how does it differ versus your typical fully insured model, advantages of self-funding, why does somebody want to do this in the first place, and then we're going to talk a little bit about captive arrangements, which for us have been a really great vehicle for helping fully insured groups transition over to a self-funded plan. So something I'm really excited about talking about this with you today. But my standard disclaimer before I start, if you take nothing else away from this presentation, I just want you to know that myself, Josh, and Keck are all here to be resources for all of you. So, if any of this interests you, if you need more information, if you want to just ask questions, all of us are available afterwards. You can find me on LinkedIn. I think you should probably all have Josh and Keck's contact info. Don't hesitate to reach out. I'm always happy to answer questions, jump on a phone call and walk you through stuff and help you figure out if this is, something that's right for you to look into or not. And I know that Josh and Keck feel the same way. So really make us a resource for this stuff. This is what we're here for. And, I'm really excited to be presenting because this is a part of my job that I love. I like providing education, especially working, with smaller local companies around here. I'm a small town Northern California guy, and I really love the opportunity to work with, similar type groups up in this area as well. So with that, I'm just going to go ahead and dive right in here. And like I said, we're going to keep it pretty high level. So don't expect to walk away from this being an expert, but I really just want to give you an introduction to this stuff so you can start to feel and start to learn a little bit about it. And then, if we want to get more information later, we can definitely follow up, with more detail. But just remember, this is going to be pretty high level. Okay, so what is self-funding? When we think of a health plan for our company, the fully insured model is what most of us typically think of, right? And in this model, we're paying our premiums to the fully insured carrier like a Cigna or an Anthem or United Healthcare, and those premiums go towards funding everything within the health plan, right? This is typically what we think of when we think of insurance. That's our call that our standard model. But right alongside that, you see we have our self-funded model. It's kind of the same, but kind of different. And that's what we're going to talk about, right? In the self-funded model, instead of the employer purchasing an insurance policy which covers the medical claims of all their employees, the employer is actually choosing to fund those claims out of their own bank account. So really, they're designing their own health plan. They're paying the claims themselves. You'll see here, associated with that, they have plan design choices where they can actually customize their benefits plan. They can choose the network that they want to use, the claims administrator that they want to work with, stop loss carrier choice. You see that up in that right-hand corner there. That's my piece of the puzzle. But like we said, we're not going to dive too much into that today. We want to keep it a little bit higher level than that. And then picking, their own pharmacy benefits manager, which provides, their prescription drug plan for their employees. When I talk about this model, you kind of think of it as a plug and play model, right? It's like the employer is building their own health plan and they're plugging in the pieces that they want to work with, as opposed to the fully insured version where you typically get limited ability to customize those plans, right? If you're purchasing it from a particular carrier, you don't really get your choice of networks. You kind of get what they offer. You're a little bit more canned. So think of this as sort of the plug and play model. And what I'm going to do is we're going to look at both fully insured and self-funded, and you're going to see like the skeleton of these plans, how they work, and then I'm going to compare them to each other. And you're going to kind of see that the basic skeleton and the model is the same. The things that are happening within the plan are basically the same. It's really just a difference of who's doing what the roles are of the employer and the insurance carrier in each model. So we'll start out by taking a look at the fully insured health plan. So this is typically, like we said, this is what we think of when we think of medical insurance from our employer provided to our employees. You'll see up at the top there, the insurance company charges premiums. The employer pays those premiums typically on a monthly basis, and those premiums go to cover everything within the health plan, right? So that's covering your administration, who's actually getting the bills in from the providers when your employees go into the doctor, go into the hospital, and incur those claims. So the fully insured carrier is receiving those bills, they're processing them, they're typically applying their network discounts or their pre-negotiated pricing at those different providers, and then they're actually the ones sending the payment back out to the providers. So the doctors and the hospitals all get their payment for their services. You'll see in the middle there, we've got costs that are included within this plan, right? So we've got typically premium taxes, which are, you're taxed on the premium that you're paying to the fully insured carrier each month. So part of that money is getting pulled out to pay those taxes. We typically have some pooling charges built in there, right? The fully insured carrier is spreading the risk, not only for your plan, but they're spreading it across their entire book of business. So they're kind of combining everything to balance out the risk between all the different companies that they insure. And general expenses, right? They have to pay their employees, they have to keep the lights on in their building and all that stuff. So they have their own expenses built into that. And then you'll see over on the right-hand side, the biggest chunk of the money every month goes towards actually funding the claims that the employees are incurring, right? So when somebody goes into the doctor, they go to the hospital, they fill that prescription, you see those medical and RX claims. The biggest chunk should be actually going towards paying those providers. You see down there too, they carve out a little chunk of that for reserves, kind of building up a little emergency bank account if the next month is a little bit more expensive than the last month. But the important thing you'll see down at the bottom, all that money each month that goes towards paying those premiums, if any of that money isn't used up in all these functions that we talked about above, the fully insured carrier keeps that as potential profit at the end of the month. And the analogy that I like to make is this is like paying your cable bill. So example, for me, I have YouTube TV as my TV provider. I think my bill, it just got increased to around $70 a month. Now, I pay that amount to YouTube TV regardless of how much or how little TV I watch in any given month, right? I could never turn the TV on once in the month, or, like today, where after this presentation, I'm going to go put basketball on for the rest of the day. And for the next few weeks, I could have my TV on 24 hours a day. That bill is going to be the same amount regardless of my utilization, right? So how much or how little TV I watch doesn't impact what I'm being charged each month. Think of the fully insured plan in a very similar way, right? So you're paying that set premium amount each month, regardless of how much or how little your employees are utilizing the plan. You could have a month where nobody goes to the doctor at all, and that big potential profit number down at the bottom there, the fully insured carriers keeping that big chunk of money as profit themselves. They don't call you up and say, hey, good news, we had a really good month, we didn't use the plan that much, so we're going to send you some money back. That's not how it works. They hang on to that. So keep that analogy in mind when we're comparing the fully insured model to the self-funded model. Okay, so on the self-funded model, here's the skeleton for that plan. And you'll notice, right, it basically looks the same as what we just looked at before. The basic structure is the same, but the key difference is up here at the top, instead of paying the premium to the fully insured carrier each month, the employer self-funds their benefits out of their bank account, right? So they've set aside their own special bank account for funding their medical plan, and they're pulling money out of that account each month to fund all the different functions of their health plan. So again, you'll see over on the left-hand side, administration, right? We still need somebody that's going to get the bills in from the providers, apply discounts and actually send the payment out to the providers. You as the employer, you don't want to be handling that yourself, right? Your job is to be a construction company or an architecture firm or a finance firm or something like that. You're not wanting to take on the role of actually administering your own claims. So we hire what's called a third-party administrator. It's a company whose sole purpose is to provide that administrative function for self-funded plans, right? So we're hiring our third-party administrator to actually process our claims. You'll see in the middle there, we still have some other costs associated with the plan. We typically have some administrative fees. We're typically paying to rent a PPO network that our members can use to stay in network and get those in-network discounts. You'll see stop loss listed on here as well, specific stop loss and aggregate stop loss. Again, that's kind of my piece of the puzzle that I specialize in. We're not going to dive too much into that today, but just keep in mind, this is a form of protection that protects the self-funded plan against really high costs, right? So this is our catastrophic claim protection. If somebody has some really high claims that we're not anticipating, our stop loss coverage is there to protect us and cap our maximum liability. And then, again, on the right-hand side, the biggest chunk of that money every month should be going towards actually funding the claims of our employees, right? So our members are going to the doctor, they're going to the hospital, they're getting their checkups, getting their services and all that. We get those bills in, and we're holding a chunk of money from that bank account each month to actually pay those providers. We're typically setting a little bit of money aside each month too as reserves. We want to build up that emergency bank account in case we have a bigger month down the road. We have that money on hand so that we're able to fund those claims. But here's the really cool part down at the bottom. Any money that we didn't use out of the bank account that month for any of these other functions, the employer gets to keep it as potential savings, right? They can put that into their reserves and really increase that reserve account. They can deploy that money somewhere else within the company. They want to hire a new employee, buy a new piece of equipment or something like that. It's their money. They can just keep it in their bank account and continue to earn interest on it. The important part is if it didn't get used up, it's not profit for the insurance carrier, it's savings for the employer because we're actually paying all these functions out of our own bank account. The analogy I like to make here is this is like paying your electric bill. Right? So you get your electric bill every month, and if you've been good throughout the month about turning the lights off when you're not in the room, adjusting the air conditioning, maybe we don't run the AC full blast all summer, 24 hours a day. If we control our utilization, we can actually decrease our cost, right? So if I'm good about controlling my utilization throughout the month, my electric bill is going to be lower. I can have an impact on my actual bill each month, as opposed to the analogy we made before, the cable bill, my utilization doesn't impact that. Right? My bill is set every month regardless of how much or how little I use. With the self-funded plan, the electric bill analogy, we can actually impact our utilization and ultimately decrease our costs. So always keep that in mind. That's my nice, easy analogy, cable bill versus electric bill. Okay, so that's kind of our basic overview on self-funding. What is it? I want to give you a quick little history lesson on self-funding before we go further. And the important thing that I want you to take away is this isn't a new thing. This isn't some trendy new hot way to save money on our employee benefits plan. Self-funded plans have existed for a long time. I think the first self-funded plans came out in the 70s and 80s, but in the past, it was really limited to your really large employers that would self-fund, right? We're talking your 1,000, 2,000 employee groups were really the only ones self-funding in the past, really because it was the ones that it made the most sense for, right? They typically had employees spread out all over the country. They had the bigger groups, and it made more financial sense for them to self-fund their health plan. You can see on my little timeline here, back in 1999, this was actually before I was in the industry, but it was about 44% of the U.S. workforce was on a self-funded plan versus a fully insured plan. When I started in the industry in 2006, we were pretty close to an even split. I think it was 49% self-funded, 51% fully insured, which for a lot of us, that can be surprising because if you're not really in the weeds on this stuff and know about this stuff, most people don't even know that self-funded health plans exist, right? And to think of, at that time, 18 years ago or wherever it was, about half of the U.S. workforce was on a self-funded plan. Most employees don't even know whether their plan is fully insured or self-funded. So a little history lesson here. In 2010, you probably all remember our country passed the Affordable Care Act. This really increased the interest in self-funding among your small and mid-sized companies, right? Because this Affordable Care Act was driving up costs. People were looking for different ways to lower their costs, control their costs on their medical plan. And that's when smaller groups started turning to self-funding. And there started to be more options for those smaller groups, more options that made financial sense for them to self-fund. More broadly, the introduction of captive programs, which we're going to talk about in a little bit, came along, and that really opened up some different avenues for your smaller, mid-sized group that in the past hadn't considered self-funding. It really became more feasible for them, and really the growth has taken off. You'll see in 2016, we had about 61% of the U.S. workforce is covered on a self-funded plan versus a fully insured plan. I think the most recent number I saw was from 2022, where it was up to about 64% of the U.S. workforce on a self-funded plan. So, and it's important to know that growth in the recent years, it hasn't been on the high end, right? It hasn't been those jumbo employers. Those groups, the ones that were going to self-fund, they've already done it years ago. The growth is really coming in that 50 to 1,000 life space, where, like we were talking about, it became more feasible. There became more interest within this segment to look at self-funding as an option. So keep that in mind. The things that we're talking about right now, the size of employers that we're talking about, if you're in this 50 to 1,000 life space, this is where a lot of interest is coming from, and where we're seeing a lot of that movement from the fully insured market to the self-funded market. Okay, so that's my overview on self-funding. What is it? Our little history lesson here. But then we ask the question, okay, Brian, why does somebody want to self-fund their health plan in the first place? Well, it just so happens I have a slide with several bullet points that kind of talk us through that. So I'm just going to go through a few of these. The number one bullet up there, not subject to state mandated benefits. Now, I mentioned ACA passing in 2010, and some of you might remember, along with ACA passing, what happened is with that, every state kind of came out with their list of, hey, if you're going to have a health plan within our state, these are the things that we are requiring you to cover no matter what, right? And it can be, around certain types of benefits or certain allowances within those benefits. Important thing to know is self-funded plans are not regulated on a state level. They're regulated on a federal level. So what that means for the self-funded plan is that you don't have to comply to those state mandated benefits. Now, there is an overarching set of federal mandated benefits that we do have to comply with, but I think they're generally less restrictive as the state mandated benefits. And also keep in mind, if you're on a self-funded plan and you have employees in multiple states, you don't have to comply to the different requirements of each of those different states. Whereas with the fully insured plan, if you have employees in different states, you do have to meet the mandates of each of those different states that you have those employees in. So it really simplifies things, and it can help reduce costs by eliminating some of those requirements of what you have to cover on your health plan. Our next bullet, plan design customization opportunity. This is actually one of my favorite things to talk about within self-funding. In the next couple slides, I'm going to do like a little mini case study that specifically talks about this. So we'll go into more detail there, but the big thing to understand is with the self-funded plan, the employer actually owns this plan. They're not purchasing a plan from somebody else. They are building their own health plan. And what that means is they have the control to customize those benefits to be what they want them to be. So if they notice a need within their population, some type of service that their members really want or need, they can actually alter their plan to cover that service, or vice versa. If they're noticing something really expensive that's getting taken advantage of and they want to eliminate that coverage from the plan, they have the ability to change that plan even mid-policy year and customize it to kind of make it what they want it to be and to meet their needs. Lower state and federal taxes. We kind of touched on this earlier, but the important thing to know is with the fully insured plan, you pay premium taxes on the full amount of premium that you pay each month. And like we talked about in that skeleton fully insured model, that's how you're funding the health plan with the fully insured model. You're paying this big chunk of premium to the insurance carrier, and thus you are taxed on that big chunk of premium every month. With the self-funded plan, the only premium that you're actually paying is for purchasing your stop loss insurance. Very small piece of the puzzle compared to the fully insured plan. So by going self-funded, you automatically reduce your tax liability and provide savings there. Greater cash flow control. We sort of talked about this in the previous slides as well, right? At the end of the month, that money, if we didn't use it to perform all the functions of our plan, we get to hang on to it. We can keep it in our bank account. We can earn interest. We can use it for reserves. We can deploy it somewhere else within the company. It's our money. We get to choose how we're using it instead of just paying that big chunk of premium to the fully insured carrier at the beginning of every month. Potential savings versus fully insured plans. We talked about this, the cable bill versus electric bill example, and the ability to control our utilization and actually drive down those costs by being aware of what we're spending our money on, how we're spending it, and taking control of that plan. Modular approach for best fit vendors. This is that plug and play thing that I was kind of talking about in the beginning there. Because the employer owns their self-funded plan, they can plug in the vendors that they want to work with. If they recognize that, hey, we've got some employees out in a different area and they might benefit from using a different network than my employees that are over here, they have the ability to, combine that and hey, we're going to provide this network for you guys, this better network for you guys that better fits your area that you're at. Or if we notice something going on within our plan, for example, if we have a couple members that are on dialysis and that's driving our claims every month, we can bring in a cost containment vendor that just specializes in controlling dialysis claims costs. We can implement that and basically react to what we see the needs of our program being. So we have the ability to plug in the vendors that are going to fit our plan and accommodate the needs that we have. And then the bottom one, this is kind of the engine that drives everything else, increased claims data access. This is one of my biggest frustrations with fully insured plans, especially in that small to mid size, employer segment, our 200 to 500 employee segment. When you're fully insured, you don't get a lot of good access to claims data, right? Your carrier will come in and they'll give you your renewal each year and they'll probably give you an increase, but they're not going to explain to you why they're giving you that increase. They might give you a high level loss ratio or something like that, but they're not going to say, hey, you had 3 dialysis claims or you had a transplant and that really drove high costs. You don't get access to that type of claims data when you're fully insured. But like we've kind of talked about before, when you're self-funded, you own that plan and you get full access to that claims data. You can get this data, on a quarterly basis, a monthly basis. You could get it on a weekly or even a daily basis if you wanted to look at a snapshot of, hey, what's going on with our plan right now? What are our employees spending money on? Do we have a couple particular diagnoses that are driving high costs within our plan? And if so, let's take a look at those and figure out what we can do to help control those costs. Do we have a member that's on a really high cost drug that we could source somewhere else at a better price and help reduce that utilization and lower that cost? Once you have access to that data, you can do all these other things that we talked about up here, right? Customizing our plan, customizing our benefits, choosing the vendors that we want to plug in. Typically, most employers, their health plan is the second largest item on their balance sheet next to payroll. And not having a line of sight to what that money is being spent on every month for the amount of money that it is just insane, right? Under normal circumstances, you would never spend that much money and not know what it's actually being spent on. Within the self-funded plan, you get access to that data. You can understand how your money is being spent and then ultimately take control of that. Okay, so the next thing I wanted to do, I wanted to do this quick little case study on plan design customization. And I came across this a few years, and I really like this example. It's kind of an extreme example, but I think it's a good way to illustrate the ability to customize the self-funded plans to meet the needs of the group. And it doesn't just have to be around controlling costs. It can be to accomplish, other goals of the organization. So this is really based around fertility benefits. Now, if any of you have been through fertility treatment yourself, or you have friends or family that have gone through this, you know that it can be a heck of a process, right? It can take a long time. It can be very expensive. Average cost of a successful outcome for fertility treatment can be up to $70,000. And if it's not successful, you might have to do it again and start all over again and incur that, $70,000 bill again. The problem is that most fully insured carrier-based coverage for fertility is typically limited to about $15,000 per the lifetime of the member, and it's restricted by diagnosis. So that means if you're a same-sex couple trying to go through fertility treatment to have a child, your benefits are probably not covered by that fully insured plan because that's not a diagnosis situation. So limited amount of benefits, that $15,000, that's really going to just scratch the surface on that overall $70,000 bill, and limited to diagnosis requirements. But the other thing that we know is this can be a very important benefit for some employees. You can see some of the stats down there. Employees willing to change jobs over access to these types of benefits. Overall, we're seeing 68% of employees surveyed said yes, they would change jobs in order to make sure that they have access to this type of coverage. 70% of millennials agreed that they would change jobs, and 90% of those facing fertility issues said, I would be willing to change employers to make sure that I have access to this coverage. So what we know is it's a really important benefit to some people, right? And especially knowing, we're joining the workforce, we're recruiting these younger employees now, these people coming out of college or coming out of high school, and we're hiring them on. This is something that's very important to that population. So this could be seen as a downside, but I've actually got a really cool example of employers that have recognized this need and customized their plan to actually take advantage of this. So you'll see up here, obviously all big names that we know about, particularly focus here in Northern California and Silicon Valley, but companies like Salesforce, Pinterest, Facebook, Google, LinkedIn, these companies are all big employers on self-funded plans. And what they did is they recognized that this is something really important to the employees that they're trying to recruit. And they realized, hey, we're all lumped in this same geographic area. We're probably all trying to recruit the same group of talent, right? We're all fighting for these employees. We want to pick the best ones and we want them to come work for us. So what they did is they recognized that these fertility benefits can be extremely important. So they took their self-funded plan and they customized it to really beef up those benefits and make sure that they're providing really awesome coverage so that when they're fighting to recruit that employee, they can go in and say, hey, if this is something that's important to you, come work for us. We've got awesome benefits. We've got awesome benefits around fertility. Come put your time in with us. When you're ready to start a family, our plan is going to make sure that you have the ability to do that. And they're actually using their self-funded plan as a recruitment tool to compete for that best talent that all their other competitors are going after as well. Now, the thing that I want to say about this is this is a very extreme example, right? These are all big name companies, large employers. They get a lot of good publicity for providing these types of benefits. So don't think that by having a self-funded plan, the expectation is that we're going to go overboard and we're going to offer every single member $100,000 of fertility coverage, because I know that's not financially feasible for most of us. Maybe a more attainable example for some of you would be something that happened back in early 2020. I'm sure you all kind of remember what I'm talking about. But the big thing that we saw as a stop loss carrier at that time, helping out our clients that are on self-funded plans, we had a lot of groups reaching out to us when the pandemic hit and when people were suddenly stuck at home, not able to come into work. We were getting a lot of calls from self-funded groups saying, hey, currently, the eligibility language within our self-funded plan requires our employees to be coming into the office or working 30 hours a week or this or that in order to qualify for benefits. We don't want our employees to lose access to these benefits. We want to modify our eligibility language to make sure that even if that member isn't coming into the office, the minimum 20 hours a week or whatever it is, we want to make sure that they still have coverage. Because they are self-funded, they were able to go into their plan, customize their eligibility language at that time, and make sure that their employees that they wanted to keep on the plan maintain their eligibility and maintain their health benefits. needs. That's like a real life example of how we see self-funded groups customizing their plans to meet their needs. So I like sharing that. I think it's a couple cool examples and real life things, right? We're not talking in hypotheticals here. These are real things that we see in the market that we see our self-funded clients taking advantage of to meet their needs. Okay, so that's my overview and my history lesson and my why do we want to self-fund in the first place. So be happy to answer questions on that towards the end of the presentation. But what I want to touch on right now is captive arrangements and kind of explain to you what this is and why it can really be a good opportunity for small to mid-sized fully insured employers to make that transition to self-funding. So some of you might have heard of captive programs. Some of you might even be on a captive program with your workers' comp or your P&C benefits. So really, captive, something that were really popular on the P&C side and have gained a lot of momentum on the employee benefit side as well. So I'll start with a basic definition. When we talk about a captive, what is a captive? The technical definition is a captive is an insurance company that is formed for the sole purpose of providing benefits to its owners. Okay, so kind of a complicated response there. In the real world, this doesn't necessarily make a whole lot of sense to us. So the easier way to think about it is a captive is a group of similar employers that have come together to pool their risk and work together to give them the leverage, the buying power, the stability of a much larger employer. But they're doing this by combining a bunch of small to mid-sized groups together instead of being this one really large employer, right? So when you think about captives, think of it as a pool of groups that want to work together to help spread their risk out and provide more stability. And I'll go into a little bit more detail on how that actually works. So in this example, we see we've got a few different employers working with their different brokers. They want to move over to a self-funded plan and they want to join a captive because they know that, hey, if we're a small group on our own, our claims can fluctuate a lot month to month. We don't really have that same stability as a really large group might have. But if we join into this pool of other groups that are already doing the same thing, already self-funding within this captive program, we can get access to a lot more stability and we can help spread out our risk. So if we have those tough months or that tough year, we know that we're not just hanging out there all on our own. So in this example, employers work with their brokers to join a captive. You see your captive manager there. Important thing to note when we're talking about joining this captive, we're not building this from scratch, right? We're not going out and saying, hey, we got to find 50 other groups that want to work with us. We're joining an established pool, an established captive of groups that are already doing this, and they're happy to welcome in the right new members that want to join in, that think the same way and want to take advantage of their health plan in the same way that they're already doing it. They're happy to welcome in these new members to join in their program. So in this example, the group joins the captive. They become a part owner in that captive. So like I said before, right, it's a captive is formed to provide insurance coverage to its owners. So in this situation, when you join a captive, you actually become a partial owner in that captive. But here's the cool thing is you're not just lumped in with everybody else. You still have your own standalone self-funded benefits plan. So you get to choose the plan that you want. You can customize it like we just talked about. You can choose the network that you want to use. You can choose the administrator that you want to work with. You do still have your own standalone plan. You're just pooling risk together with all these other groups to help smooth things out and provide more stability. Yeah, so that's kind of like the basic concept of this. The one thing I will say, though, I like to say this, if there's a lot of different captives out there, right? It's not just one or two. There's several different captive managers that are doing this type of thing. And I always say, if you know one captive, you know one captive, right? Everyone's a little bit different. Each of these programs have their own different nuances. They all are generally doing the same thing, but a lot of the details can be different. So I say never assume that you know about this captive because you talk to that captive. So always, if you're looking into this, if you're going down the road, ask the questions, rely on your resources. Josh and Keck are awesome resources here at Bender to help you, guide through this process. They work with several different captive programs. They know the ins and outs. They know the strengths and the weaknesses, and they're happy to help you along, through that process. So I really encourage you to lean on them through that process. They know the right questions to ask to get you to the right spot. Okay, so when we're talking about captives, two basic kinds heterogeneous and homogeneous. Heterogeneous captive is made up of groups from all different industries, right? So we could have, an engineering firm, we could have a construction company, we could have somebody in healthcare, we could have a retail firm, we could have an accounting agency, all different industries coming together, joining forces within their own little pool. Homogeneous captive is a captive that's made up of groups all from within the same industry. So we see homogeneous captives for the construction industry or the healthcare industry is pretty common. For the most part, when you're looking at captive programs, you're mostly going to see heterogeneous ones, made up of groups from all different industries. In some situations, it might make sense to look at a homogeneous captive. You might think, hey, we're a really specialized industry. We want to work with groups that are similar to us, doing the same things, that have the same types of concerns that we do, that really understand us, and that we're going to share a point of view with. That can be really great, but also the challenge there can be diversity within your pool, right? If you're all in the same industry and that industry suddenly goes through a downturn, economic tough times, that can put a lot of pressure on everybody within the captive at the same time, versus a heterogeneous captive. When you're spread out amongst a bunch of different industries, kind of gives you a little bit more diversification. So, if one industry is going through a tough time, you can still have the stability of everybody else kind of spread out over different industries. So it doesn't mean the whole captive is going to suffer. I kind of like that approach of keeping things kind of balanced. So you're not putting all your eggs in one basket, right? You're not all lumped in together with people of the same industry. But the important thing to know is even though you're joining a captive of groups from all different industries, the important thing is that the mindset of all these groups are the same, right? They're all making the same decision that you've made to go to a self-funded plan, join forces with similar type groups that want to control their costs and provide great benefits to their employees. They're all making the same types of decisions. They're facing the same types of challenges and questions that you are. They can be an awesome resource for sharing insight, sharing experiences. If you run into a particular situation within your program, you could be in a captive that, hey, there's probably 10 other groups that have experienced the exact same thing at some time in the past. They can be a great resource to lean on to reach out to those captive members and say, hey, we're having challenges with this type of claim. Have you ever run into this before? What have you done to address those types of claims? So even though you might be spread out amongst different industries, keep in mind that you're working with people that have a very similar mindset and are working towards similar objectives. Okay, so why employers choose a captive? A few bullet points here. Ease the transition to self-funding. I've worked in this industry, like we said at the beginning, for 18 years, and it's really just recently, probably in the past 5 years or so, that here in California, the captive model has really gained a lot more momentum, and we're seeing it as the best program that I've seen to convert those fully insured groups over to self-funding. It can be a challenge making that conversion to self-funding. You think about, when I put up my skeleton there and all the different things that we have to do within our self-funded plan, getting a TPA, building our own plan design, setting up our bank accounts. The nice thing about a lot of the captive programs is they've already thought through this stuff for you, and they make it as turnkey as possible. You still have the ability to pick your own vendors, choose your network, customize things, but they've really built out the structure and made the transition very easy for you. The other great thing with the captive programs is, remember how I talked about that access to claims data, and how when you're a smaller or mid-sized group on a fully insured plan, you don't get good access to that claims data? That can be one of the biggest challenges in converting from fully insured to self-funding, because your stop loss carrier that you're going to work with on your self-funded plan, in order to price you appropriately, a lot of times they're going to want to see that claims data from your prior years. They're going to want to know, like, what type of claims do you have? How much money has your plan been spending on claims every month? And if you're fully insured, you might not have access to that type of data. The nice thing with the captive program is most of these programs allow you to make that transition even if you don't have access to that claims data. Kind of because you're joining a pool of similar groups, they have a really good idea of what to expect for claims, and because you're diversifying your risk within that pool, gives you a little bit more wiggle room and a little bit more ability to make that transition without having access to that claims data. Pool and share risk, we kind of talked about this before, right? You're joining similar groups that are going to spread their risk out. So if one of us has a tough couple months or one of us has a tough year, we're not completely on our own. We're able to spread that risk amongst our other captive members and then know that, hey, when we have that good year and somebody else has that tough year, they're going to lean on us a little bit more. But ultimately, we're all going to share in our risk working towards our common goals. Reduce claim volatility. If any of you remember, our high school math or stats class or anything like that, the law of large numbers. As things get bigger, they get a lot more predictable. That's why it's been historically a lot easier for your really large groups to self-fund, because their claims are a lot more predictable. It's a lot easier to know for 1,000 life group approximately what our claim spend is going to be every month. But when we're a 100 life group, we could have 1 or 2 people that go to the doctor unexpectedly that really spike those claims from month to month. So the larger you are, the more stability that we have. So by taking all of these small groups and pushing them together into this pool or this captive program, we kind of gain that stability of the larger group, and things become a lot more predictable month over month. So it eliminates that volatility, that month-to-month swing that can happen when you're a smaller group self-funding on your own. And then our last point there, profit share when experience is better than expected. So I've talked about spreading this risk, right, and leaning on your other captive members when you have a tougher month. The good thing, though, is at the end of the year, typically, these captive models, a lot of them have a profit sharing component where, hey, we all kind of pitched in some money to pool our risk. At the end of the year, we ran better than we expected. We all collectively spent less money on claims than we thought. Good news, we're getting some of that money back, or we're rolling it into our reserves for next year. You really have the ability to share in that profit, and that because you're working with groups of similar mindset, working towards similar objectives, everybody should have that same goal of controlling utilization, controlling costs. Let's minimize our expenses so that at the end we all get that bigger, profit share back at the end of the month or at the end of the year. So how companies work together, we kind of talked about this. Captives are licensed insurance companies owned by the members. So you own a piece of this captive. When you join a captive, you're actually purchasing into a share of that company. If you do want to leave, so it's an important thing, I didn't mention this before, the name captive can sound a little daunting, right? It kind of sounds like, oh, I'm going to join this program and then I'm held captive. The name can be a little bit misleading. You actually have the ability to leave this captive when you want to, right? So even though you've bought into it and you're a partial owner in the company, if you make the decision after a year, 2 years, or 5 years, hey, this captive thing, we've kind of run our course, we're ready to go out on our own, you have the ability to leave the captive, take your plan with you, take your share of your profit share with you, and move on and do your own thing. But important to know, you are a partial owner in that captive program when you're within the program. Like I said, each employer within the captive, they still do have their own standalone plan. We still have the ability to customize our benefits like we talked about. You choose your stop loss carrier. You choose the administrator that you want to work with. You can choose the networks. You can choose which cost containment vendors you want to put into place. Some of the really good captives, they have their own preferred list of cost containment vendors, so you don't have to figure this stuff out on your own. You could say, hey, we've got somebody on our plan that might have a transplant coming up soon. What are our solutions? And the captive already has those vendors ready to go for you. So it's in their general interest to help control the cost too. So some of them have done a really good job of vetting out those vendors and kind of having those programs ready for you to utilize when you need them. But important to know that you do still have your own standalone self-funded plan within that captive program. And then you see there at the bottom, based on performance, everybody's pooled together. You're sharing in the profits or the losses distributed amongst the groups at the end of the policy year. So if we all put in our really good effort, we controlled costs, things ran well, we're going to get some of that profit share back, and we're going to share it amongst all the members within our captive. Okay, so who's the right fit for captives? I would generally say, common theme here, right? We've talked about your fully insured groups that are in that 50, 100 employee to 250, 500, even larger. We've seen larger groups, 6, 7, 800 lives that wanted to join in the captive program. So there's really not a maximum level, but I would say there's kind of that sweet spot, that 50 to 500 or so lives. Those wanting to transition to self-funded. So typically, if you are self-funded already and you want to join a captive, you can absolutely do that. Where we see the majority of the growth coming is from those fully insured groups that want to make the move to self-funding, but they don't want to do it on their own. They want to have that stability. So that's really where it tends to be a good fit. And I would say more than anything, it's the mindset of the company, right? So the captive is going to be looking for groups that think the same way, that are tired of getting their fully insured renewal every year and not having any justification as to why their rates are increasing. And they've said, you know what, we finally had enough. We want to do something about this. We want to take control of our plan. They're looking for members that are willing to think outside the box, willing to put in a little bit more effort, right? Because it's going to be a little bit more work to get that self-funded plan set up, but you're going to see the rewards from it. So they're looking for members that have that mentality of, hey, we want to do something different. We're willing to think outside the box and make some changes that are going to help us in the long run, improve, our costs, lower costs, improve the value of the benefits that we're providing to our members, and generally have that same mindset. They want to work together. They want to share ideas, share best practices, and then ultimately knowing that, hey, if we're helping our friends within the captive, we're ultimately helping ourselves because we're all pooled in this together. It's really the biggest thing, if I could say, more so than size or location or industry. It's really that mindset, that mentality of we're sick of paying these increases and we're ready to do something different. Okay, so that's really my overview. We touched on self-funding, talked a little bit about why we make that transition and the captive model. The one thing I want to leave you with before I hand it back over to Josh and Keck to talk about a couple other things is resources. Like I said, if you take nothing else away from this, know that we're here to be a resource for you. Happy to answer questions, happy to talk through any of this stuff. I would say if you're thinking about this, if it sounds interesting, if you're wondering if it might be the right fit, let's just start the conversation, right? Ask the questions. It does take some lead time if you want to make this switch and you don't want to end up in a situation where you're looking back last year and you thought, hey, that was a good idea. We should have acted on it then. We kind of wasted a year not doing it now. A lot of times the transition isn't quick. A lot of times it takes, having that conversation the first year, getting comfortable with the idea, and then making the decision to make the move next year. So I would just say, make sure you use all of us as a resource. One additional resource that I want to offer, I've got access to some really great benchmark data. And this is something that I do for my clients is I have the ability to take a census for one of my clients and benchmark them against groups of similar size and industry. So if you're a 500 life bank and you want to see how you compare to groups within that same industry and that same size that are currently self-funding your benefits, I've got access to that type of data. We've got this really big book of business that we can pull from across all different sizes and industries. So I'm able to put together this cool benchmark report that shows you like, hey, how do we compare demographically? How do we compare risk-wise? If we want to make this change to self-funding, what are the right, levels to do this at? What are the right plan designs to use? I'm a big fan of cheating off the smart kids, right? We don't have to invent this stuff ourselves. We can look at the really smart people that have already been doing this, and let's take some notes from them and let's use their experience to help make the right decisions for us. I've got access to this awesome tool. If you guys want to see this for your particular group, I can put together this customized report. It's a really great way to start that self-funding conversation if you want to see if it's the right fit for you. I'd really encourage you, after the presentation, talk to Josh, talk to Keck. They can coordinate getting that info and putting this report together with me. They can share it back with you, kind of walk you through it. And that's really a great way to start this conversation if you're thinking, is this going to be the right fit for us? So like I said, happy to do that for you, but definitely make all of us a resource. Hope this was helpful. I'm going to hand it back over to, I think, Josh now, and he's going to take you through a couple more things before we wrap up. And then obviously I'm on here, answer questions in the end. If there's anything that you've been thinking about, happy to answer those questions.
So Brian, when you say that you'd rather copy off the smart kids, well, I agree completely. That's why we invited you to this presentation. Thank you for doing such a great job and a very thorough job on giving us an overview of self-funding and captives. I think that was great. Awesome. So for the folks on this call, basically what we want to do for the remainder of this time is just give you an idea of what we do as a brokerage firm to partner with folks like Brian and our captive partners to be able to provide solutions for you, particularly in this space. And Brian, if you go to the next slide here, we wanted to do a couple of case studies. Now I have one and Keck has one, and so I'll let her speak to her own. But everything that Brian talked about, I have one case study in particular. One of my construction clients has about 210 employees. we moved them to self-funding for, I think some pretty obvious reasons, all the reasons that Brian talked about. Okay, we've been getting increases from our fully insured plan. Where this client is located needed to be on a PPO, and their PPO provider, in this case it was Aetna, gave them a 45% increase. And so we started having this conversation about the long view of a self-funded, a captive self-funded arrangement, in order to really control our costs. And that was really the conversation that we started having with this particular employer is, look, if we stay in a fully insured situation, we're going to constantly be at the mercy of the rates are going to go up how they want. In this situation, negotiating your way out of a 45% rate increase is impossible. It's just impossible to negotiate your way out of 45%. We tried, we got down to 20 some percent, but that still wasn't where we needed to be. And so we really helped this client latch onto this idea of the long view of being on a self-funded program. And certainly all the questions came up. Hey, what if we have a bad year? What if this? What if that? And I think Brian did a really good job of answering those questions, because there's so many levels of protection in particularly a captive self-funded arrangement, that those employers who are currently in a fully insured plan can have, I think, a high level of peace of mind that things are not just going to get out of control, and then all of a sudden your costs are going to go through the roof, and all your employees are going to max out their specific deductibles. For all intents and purposes, when we put in a self-funded plan like this, employees kind of feel like this is, they get an Anthem Blue card or Anthem Blue Cross card, and they feel just like PPO members when they go see the doctor. For them, their user experience is not much different than on a fully insured plan. So getting back to this, all the reasons that Brian discussed why an employer might want to come on a self-funded plan are exactly the reasons why this particular client wanted to do so. And so if you go to the next slide here, we are also dealing with a limited data. Now, you might be inclined to think, well, gosh, we don't have data. How can we make a good case to go onto a self-funded plan? And honestly, there's such great resources through our captive partners, and for instance, what Brian is able to show. So we can do a good job of predicting where we think your claims are going to come in, even in the first year. And so we can get a good idea with the predictive tools that we have to get you set where you need to be, so you're not only paying your fixed costs for this program, but putting enough in to cover your claims and also put in some reserve dollars. So these are all things that our client wanted to get after. And in particular, I think the biggest one here is just more control over this healthcare spend. Where are our dollars going? How are our employees using this information? In our previous work with this client, it's very difficult to tell them, how employees are utilizing this, because we simply are not getting a lot of data. So the great thing, this is a terrific example of things going really well. The upfront pricing was correct. We're starting to see some real stability with this client. In fact, in our second year of the program, we were able to reduce dependent rates by 5% in this particular client. So for employee plus children, employee plus family, those rates went down 5%. And I don't know about you, but in working in this business, it's very rare that we get to say, hey, we can bring rates down a little bit. And then, not to mention, even with that 5% decrease, the client still had $180,000 over and above their reserve, right? So that's money that they're putting back into the plan. And so the next year they have additional cushion. And then we can also decide what other benefit changes can we make to really benefit the employees? Is that making the benefits a little richer? Is it reducing the dependent rates a little bit further? There's all kinds of levers that we can pull as we get further along into the plan. And again, this is a long view type thing, but this client is seeing some real success in a self-funded program. And again, their employees just feel like they're on, in this case, Anthem Blue Cross, right? They take their PPO card, they check in with their doctor's office or the pediatrician or whatever it may be and get the services they need. And then those claims get funneled back through the client account or through the TPA and through the client account. So this is absolutely doable. And this client is having a great experience so far. Now, I want to turn it over to Keck. She's going to talk a little bit about her client and the experience they're having on self-funded as well.
So my case study is slightly different in that we are starting with a healthcare client. They have 600 employees, but they are brand new to self-funding, right? And this conversation regarding self-funding started at least 2 years ago. So this was not a overnight decision. We didn't come in with all these numbers and they made the decision within months, right? This is, like Brian said, takes a lot of education, a lot of time to understand the risks and the benefits of a self-funded captive. So the renewal struggles that this client had was that they also had a 25% increase with Kaiser this year. They were with both plans that they had were an HMO plan. They wanted to move to a PPO plan. Each of the HMO plans were a high deductible plan. So as you can see here as an example, Kaiser for the deductibles was a $5,500 individual for the individual deductible, and then the family was $11,000 for the family deductible. So they wanted a plan that could outperform their current benefit structures that they had, because it was truly the HMO really provided them with limited access to providers that they did not have access to without the PPO option. So on the next slide, you can see that why did they make this move? Same like Josh, this client really wanted to have control of their healthcare spend. The title of this presentation is Empowering Your Finances, right? And so being able to take your money that you're spending on benefits and utilizing it in a way which allows you to control the plan design and the healthcare spend within that plan design. They were tired of the volatile increases that they were having, and they didn't have access to claims data unless it was a really large claim data over $75,000. That's the only claim data they were able to get access to. Otherwise, they didn't know what their employees were doing, how many emergency room visits they were having, how many cancer visits not cancer visit, but cancer diagnosis did they have. They didn't have any of this data, and they wanted to be able to understand how their plans were being utilized by their employees. They also wanted a richer design plan because they are in healthcare, so there is very high competition when it comes to their employees, right? Granted, they're not the only ones who are seeking tremendous talent out there, right? And so any way in which an organization can get a richer plan design to recruit and retain talent, they're trying to do this as part of that. The compensation and benefits is a great utilization tool to recruit and retain. And then the idea of getting a return premium, like Brian said, potential savings that were available in a self-funded captive made them at least take the time to educate themselves about this. So what was the results that we had? The client was able to find a PPO plan, which is Anthem Blue Cross, the largest network in the nation, right? they were able to eliminate their deductibles and copays in the self-funded plan. So they went from that $5,500 deductible for the individual and $11,000 for the family to a $0 deductible and a $0 copay. In this day and age, for what we see regarding benefits, that's an incredible plan design. Just like Brian said, it doesn't necessarily even have to do with fertilities, right? This is the kind of strategy that they were able to utilize because of their goals, and we were able to achieve it through the self-funded captive program. We were able to create a HRA, health reimbursement arrangement around the plan to also reduce their maximum out-of-pocket costs. So the other strategy we implemented with this group is that because they wanted more employees in the self-funded plan, they made the self-funded rate be less than the HMO remaining Kaiser plan. So you can drive the structure and the employees to how you want them to utilize your benefits, right? And so by making this a less expensive premium for the employees than their current Kaiser plan, they were able to increase the number of participants in the self-funded plan. So, and one last strategy that they had was that they were streamline the pre-approval process for prescriptions. So they knew that certain individuals had prescriptions that were brand name medications. And so they pre-approved that so that the employee experience was much smoother than if they were out needing to get a prior authorization for these medications that were necessary for their employees, right? So the next slide I'd really like because it breaks down what they had. So you can see here, right, the $55,000 deductible for the individual in black, the $11,000 for the family. They had a $50 copay with Kaiser. They had an individual out-of-pocket max of $65.50. So that's for the individual. And then for the family, it was $13,100. That's their max out-of-pocket, right? With the self-funded plan, the deductibles became zero, the copay became zero, and we created an HRA around the out-of-pocket max where the employer paid for the HRA for the out-of-pocket max of that $1,500 because as much as they wanted a zero out-of-pocket max, the self-funded captive said, hey, we need to have some what we call skin in the game for the employee, but the employer still wanted a rich benefit, so they created the HRA around that. So essentially now with that $1,500 out-of-pocket max, the employee is essentially paying $0 for this PPO plan, broadest network in the nation. And then next slide. So this is one of those reasons why we are excited about self-funded captives. We are excited to educate people about it because this slide talks to you about another employer who's been in a self-funded captive for 8 years. The slide shows you that in green, that's their actual dollars spent in the captive, right? The dotted line in blue shows you what we anticipated what they should have spent if they utilize all their claims costs. That's what they should have spent. And then the orange is what they would have done if they were in the fully insured, if they had fully insured premiums. So every year, this client went out to the fully insured plans and got a quote. So that they wanted to continue to compare what they would have done if they stayed fully insured versus being in the captive. As you can see here, the one exclamation mark with what if you had a bad year, right? We always have that fear that, hey, we what if we hit that maximum, and every claim dollar that we thought we would spend was spent. They did have that in year 5. In year 5, they had the company had over 500,000 in cancer claimants. So that happens. But even in that bad year, the next year they had a great year. It went down. So you can see that their claims was based on each year, and their premium was based on each year. So it's not a increase that continues just because they had a bad year. It doesn't build upon that premium doesn't build upon that bad year, right? Like you do now when you're fully insured. So the biggest piece that I love to point out on this slide is that when they compared if they had stayed fully insured versus staying in the captive, they saved themselves $4.3 million in premium by being in the captive. So this is, again, when we talk to our clients or anybody who's interested in this, the captives are picking out the best, right? The best clients, the best strategies, so that these cost savings are transferred to you as the employer. And so it does take time. It is a long-term strategy, as both Brian and Josh mentioned. This will be something that will be impactful to your organization and to your employees. But I think that you'll be excited to at least learn about the next steps and find out whether or not it's a good fit for you. I'll transfer this over to Josh.
Yeah, thanks, Keck. This is just it's just a quick snapshot of all how these things work together. So the big thing that I think what me and Keck and Brian would want you to know is we don't simply put you in this type of program and then leave you to your own devices, right? This is a highly collaborative relationship, which is great. So we'll do everything that we would normally do with a self-funded client, but we help you understand, in addition to that, we also help you understand your reporting, continue to help you with your benefit design year over year, where we should be, how employees are utilizing your self-funded plan, what levers we can pull to improve the program. So those are all things that we will continue to work on together, but all the things that we would normally do as your employee benefits broker also come as part of that whole package. So I think that's the one thing that we would want you to know, is that we put together all the pieces of this, and we're kind of the quarterback and the coach of the program, and then we do what we would normally do as an employee benefits broker, is that, and that's support you in COBRA compliance needs, reporting, all that stuff, in addition to your self-funded program. So we're not going to leave you hanging out there. We're going to offer a high level of support on a self-funding program. Go ahead and move to the next slide, Brian. So we do want to take some questions that you might have. I think a good reminder is, and Jillian, you can pop in here if you want to, but post your questions in the chat if you do have them, and we're more than happy to answer a few of them. So I don't know, Jillian, do you have some questions teed up for us?
Hi there. Yeah, absolutely. We have had a few come through. One of the questions is, what if we have Kaiser?
Yeah, that particularly for us in California here, even more specifically for us in Sacramento area, Kaiser's a big player, and look, we really like Kaiser. It's a great organization, so it's not a knock on them. But I think if you have around 150 employees, you generally will worry about, can I offer a self-funded plan? If we do, what's going to happen? Because my employees are really used to Kaiser and they're really comfortable with it. So there's a couple ways to answer that question. One, if we have to move away from Kaiser completely, I can speak for myself, and I know Keck would do this too. We'd put a concierge type service in place, and basically, to basically what they do is they help the employees make those connections. How do I get and make my doctor's visit? How do I continue care? How do I make an appointment with a specialist? Where do I find a specialist? They help. This concierge service can be built into the program so they can help Kaiser people make the transition to a non-Kaiser environment. Because look, it's not the same, but it's also not a cold, dark world out there. There's other options that employees have, and so we would put a system in place so employees can get the help that they need, so they're not bugging you. Hey, I don't have Kaiser anymore. That's super frustrating. Really, we want that to be a very smooth process, and employees be able to access the care that they need when they need it. And so we put in, like I said, a concierge type service. Now, if your group size is bigger, there's also a possibility to do a self-funded plan, like Keck's example, a self-funded plan alongside a Kaiser plan, which is also doable. So there's different ways in which we can kind of work that out, but it's an important question. Keck, I don't know if you wanted to comment any more on that.
Josh, you're correct. My group was able to have Kaiser alongside their self-funded plan. So even though they had 600 employees, only 170 chose the self-funded plan, right? So, and then there were about 200 that were Kaiser. And so it's not necessarily we have to eliminate Kaiser right off the bat, right? If we continue to create strategies that say, hey, maybe we make the self-funded plan richer, more, and lower in premium for the employees, the transition will happen gradually and naturally, and they will hear from their fellow employees about how great the self-funded plan is, and even some of the diehards Kaisers will eventually move that way, but we don't necessarily, for if you're a group that's large enough, have to eliminate Kaiser right off the bat. Now, if you're a little bit smaller, that might have to occur, right? Because there is what we call scale when it comes to the need to be self-funded, and I think those are the only additional things I would want to add.
Yeah. What else do you got for us, Jillian?
I've got quite a few. How will self-funding in captives impact our organization's tax liabilities and reporting obligations?
Do you want to take that one, Kay?
I can take it. So like Brian mentioned earlier, right? Currently you are taxed on your full premium, 100% of your full premium that you pay. While when you go self-funded, you're only taxed on that stop loss premium that is being paid. So and that stop loss premium is significantly lower than your fully insured premium. For example, if you're at a $2 million premium, right? You're for your fully insured, typically that stop loss premium is, I would say, I don't know, an example would be like 500,000, right? In that premium. Brian probably could give you a better number regarding that, but that's the difference, is that you're not paying on 2 million, you're paying on 500,000 on taxes and liability.
Yeah, I think you nailed it there, Keck. Like we said in the presentation, it's an automatic reduction in tax liability because you're only being taxed on the premium piece of it, not on the entire spend of the health plan. Reporting wise too, there are reporting requirements, but a lot of that stuff is typically handled either with your broker or your third party administrator that's doing the administration and all the reporting and all that stuff. So kind of like we said, right? It's not a new thing. We're not figuring this out as we go. All of the vendors that we work with have systems in place to manage that whole process and make the lift easier on the employer.
Okay, wonderful. What if we're too small? Is that a thing?
Yeah, I mean, I think that we would answer that question. Certainly if you're under under 50, then yeah, you're going to be too small for a self-funded program. But if you're over 50 employees, I mean, ideally you'd be right around 100 employees for us to have, start having a substantive conversation around this. But what I would say is, if you're curious about it, you want to see if this could maybe work, talk to Keck and I, and we could just start that with a conversation and see if it might work for you.
Okay.
I would want to add one more thing, is that just because you're small now doesn't necessarily mean that you'll continue to be small, right? We're all growing in this world. Our organizations, we're hoping to grow. And so even if you're at 50, you can put things in place that allows you to be able to get ready for a self-funded captive program, and allows you to get some data, allows you to get some type of information that gives you more insight into what different strategies you can move towards. So you're not necessarily stuck with just fully insured only and taking your double-digit increases, but rather you can put different strategies in place to allow you to move towards that. And it's maybe it's a 2-3 year strategy to get you to self-funded. There's also that piece.
Yeah, I completely agree there. And I would say the other thing too is the landscape is constantly changing. If you had asked us 10 years ago, does it make sense for a 150 life group to self-fund? We probably would have said no, and that answer is different now. So I would, like Josh and Keck said, if you're wondering about it, let's just have the conversation and we can figure out what options are available, or if it's something like Keck said we want to start planning for in the future. It doesn't hurt to ask the question.
Absolutely. We do have a follow-up question to the Kaiser question. We have 104 employees enrolled. 31 are under Kaiser. Can we keep Kaiser if we decide to move to a captive?
With a group that size, it might be a little tight to keep Kaiser. If I'm being perfectly honest, I mean, I think ideally in that situation, we would move you 100% over to a captive self-funding arrangement. And again, that just has to do with the numbers that are participating in the program. To split it up even by an additional 30 employees, I think would ultimately not serve the program well. So
yeah. And I think it, like Brian mentioned earlier, each captive is different, and they have different goals and different appetites as well. So some will want you to transfer 100% of that 104 over, right? And others, because that other 70 employees may look at it, right? But again, this requires conversation, and what the appetite of the captive is willing to do, and so. But I agree with Josh. Most likely, they're going to want that all 104 to be part of that captive program.
Okay, wonderful. We do have a question about a recap. Can you recap the team needed to start and maintain a plan, including a company representative?
Yeah, I mean, that's a terrific question. So on our team, it's really, for instance, it'd be either me or Keck. We also have a self-funded or self-funding expert on our team. Her name's Robin, who assists us on these accounts. She really looks through a lot of the reporting, helps us move forward in the setup and everything like that. So that's on our end. And then there's setting up of the third-party administrator to handle the claims. There's setting up of the network. There's setting up of the pharmacy benefit manager, putting all those pieces together, and then potentially the concierge service, for instance. So we handle getting all that set up. We work with the TPA and the captive and the stop-loss carrier to get all that done. So on your end, it's really, I mean, like for instance, in the example that I work with the CFO and the HR director. It doesn't require an extra person to come on board. It's not that big of a heavy lift outside of your normal fully insured plan, to be honest with you. It's just understanding the data, looking at the reports. We work with you to get the account set up and things like that. So really, in this case, it's the initial conversation is with all the key decision makers and making sure everybody's on board. But for the administration, we're working with the CFO, and we're working with human resources director on the ongoing work of the plan. So I hope that answers that question. It doesn't require an additional employee to be able to make it happen.
Yeah, and Josh, the other point to make too is that, kind of like we've talked about through the whole presentation, there's lots and lots of groups in the same situation as you guys that are already doing it. We know that a lot of times, a group in that small to mid-sized range, they might have a dedicated HR team, they might have one person, or it might be somebody doing multiple roles. So don't feel like you're alone in this, or like, oh, our HR situation isn't going to permit us. We don't have the capacity to do this. It's not the first time that we've been able to make it happen.
One additional thing too is that as brokers, we're more involved than we are even with the fully insured side. So you'll see a lot more from us, the support in addition to what it is that you're doing, especially setting it up. You're going to have our guidance. Our hands are going to be there supporting you throughout the whole process. And then one thing too is remember that you're in a member owned captive, meaning other members are also a part of this. So they meet to discuss different strategies, right? Like you have a yearly members meeting that you're a part of, where you discuss what things are you doing in your organization. So it's like-minded individuals coming together to support each other and have smarter people come up with the ideas and steal them.
Yeah, the other thing too with that, Keck, is like most things, you get out what you put in, and we have some clients that are happy to kind of do the minimum, and they don't want to do that deep dive into different vendors and cost containment programs and all that. And then we have some that once they get a taste of it, they think this is great. I want to do more. What else can we do? I want to start changing networks. I want to get a containment vendor for this. We want to see the large claims every month and know what's going on. So it really, you can kind of regulate it to the level that you want to be. We know not every group is going to want to be at that highest level, touching everything and being super involved. So you kind of have the capacity to scale it to what is going to fit your own needs.
Okay, wonderful. And this is a question for you, Brian. What is a stop loss carrier? What do they do?
Great question. Yeah, so I didn't want to go into too much detail. It could be its own presentation on its own. But basically what my company does, we're an insurance company that provides a safety net for self-funded plans. So as part of your self-funded plan, you typically purchase a stop loss policy that caps your maximum liability on the self-funded plan. So if you think about a self-funded plan, one of the challenges can be if you're self-funding those benefits, you are fully responsible for the claims within that plan. So that means if you have a $2 million cancer claimant, your company is responsible for those claims. Now, if that were the case, nobody would want to self-fund because we would know, hey, if one person gets really sick or has a bad accident or something, we could be on the hook for a huge bill, a lot higher than our fully insured bill. So that's where my company comes into place. We put in what's called a stop loss policy that basically caps your maximum liability. It's kind of like your auto insurance policy where you're responsible for a deductible up to a certain level, but if your claim goes beyond that, that's when the insurance takes over and pays for it. So our type of protection protects against catastrophic claims if we have like a really expensive transplant or a cancer treatment or a really bad car accident or something like that. We're in place to protect against those high cost claims, and we basically put a maximum liability on your self-funded plan. So we can actually show you a number within your plan and say, hey, you're self-funded, but your worst case scenario, if everything goes terrible, this is the number that you're responsible for up to that amount, right? You don't have unlimited liability. We have a cap on it that you can know, like, hey, worst case scenario, this is the max that we're on the hook for. That's kind of stop loss at a high level. If you do want to go down this road and learn more about captives and self-funding, I'm happy to do a deep dive into stop loss and get you really familiar with it. I geek out on this stuff. I love it. But I know most of you are not too concerned about the nuts and bolts on that yet, but you might be in the future.
Yeah.
Wonderful. We have a few questions left, so please be sure to send those in. Our increases have been in the double digits for several years. Doesn't that make us a poor candidate for self-funding?
Yeah, I would say not necessarily. So, I think it's a good example. For instance, in that case study that I went over, they were dealing with the same thing, and one of their issues was they happened to be in an area where they absolutely needed to have a PPO plan. And so, essentially what would happen is they would be with a PPO plan, and for a couple of years, their rates would go up into high single digits or high double digits, and they would see steady increases. And in this last iteration, they got that really high increase. But one of the data pieces that we were able to get was some high cost claims. And so we were able to make some assumptions. We look at those high cost claims and we're like, okay, none of these appear to be ongoing. These appear to be one-time things that are not going to persist in ongoing claims. And the other thing to remember is, so at least we had some peace of mind around there that wasn't lingering high cost claims. But the other thing is that the analytics around a fully insured group going to self-funding are pretty good, right? Uh, we can predict with we can kind of set an expected amount of liability essentially for a company pretty well. It's never a perfect system because certainly someone could get sick or have a bad accident or something like that. But the prediction tools around this are pretty good, particularly for those in the first year, and we can kind of set your needed claims dollars amount that we need to bring in with a pretty good level of accuracy. So I think if anything that should bring you some additional peace of mind, because we don't want to be way off in that number. We want to be like that previous slide where it showed that expected line. If you follow that expected line, that's great, and that's where those um, that's where some of that early sort of predictive analysis kind of comes in based on your age, demographics, locations, things like that. um, we can make a good enough guess to um, to make sure you're collecting enough funds in your claim reserves to cover any costs. And of course, that keeps rolling over year to year, right? So that's a good thing. You can keep putting excess dollars that you've collected back into the fund, so you have additional reserves in case you have that bad year. So I don't know. Hope that answered that question.
Can I add something real quick? Remember, everyone who's fully insured is essentially getting those double digit increases, right? So it's not an abnormal thing to get double digit increases. And those who have already moved towards self-funded captives were in the same situation you are now, getting double digit increases. And a few of our clients all experienced that 45% and 49%, whatever that driver that really finally got them to look at this model. So it's not necessarily you're the only one getting double digit increases. So
Right.
so hopefully that also helps in whether or not this is worthy of a conversation in the future.
Yeah. Yeah, Keck, that's a great point because a double digit increase doesn't mean 40%, right? A lot of times we're talking that means 12 to 15% year over year, right? And that's what we're talking about. And really in a self-funded arrangement, we want to get beyond this. Okay, maybe we get a 5% this year, but maybe gosh, we're getting a 15% the following year. We want to get off that trend and stabilize the program over the long haul, because it'll be based on the claims of your employees, and it's pay as you go. So it does bring some stability to that, and you have more control over it, which is really nice, right? It's really a nice benefit.
Yeah, I would comment too that the increase doesn't really tell the story unless the carrier is telling you why you're getting that increase, and they're probably not
Yeah.
saying, "Well, you're the worst running group on our pool, and that's why you're getting." Like Keck and Josh said, a lot of the other similar groups within that fully insured program are probably getting similar increases with no justification. So it doesn't necessarily mean that you're a bad risk or that you have high claims. You could be the one subsidizing the other groups that are really bad. But until you have access to that claims data, you don't know. You don't really know what your expenses are. And the other part of that too is say maybe you are driving high costs. Maybe you do have some high cost claimants on your plan. Until you can see that data, you can't do anything about it. But having access to that information and knowing like, hey, we've got somebody that's on dialysis that's costing us $100,000 a month. Now that we know about that, let's do something about it. You can take control versus staying on the fully insured plan and just knowing that you're going to continue to get those increases year over year.
Yeah.
Wonderful. Well, I really appreciate both of you, Keck and Josh, and especially you, Brian, for spending your morning with us. And thank you to everybody. I want to be conscious of time, so if you did ask any more questions, we'll gladly reach out to you individually after the session has concluded. As a reminder, this webinar has been recorded, and both the recording link and a copy of today's slide deck will be emailed to you following our session today. And if you wouldn't mind clicking to the next slide, Brian, I just want to share these are ways that you can connect directly with Keck and Josh. So feel free to scan those with your phone to directly schedule some time with either of them. Again, you can see these slides in our follow-up email. And I will also be copying Keck and Josh on that as well, so you can connect with them. And then if you wouldn't mind clicking one more time, we do have an upcoming Bender U that's coming up on Thursday, April 18th. This is for our construction folks out there. Protect your project with contract liability insurance. This is going to be a really great one. So you could go ahead and scan that QR code to register now. I'll also be including it in that follow-up email. But thank you again, everyone. And we hope you enjoyed yourselves, and we hope you have a wonderful day. Thanks, Brian. Thanks, Keck. Thanks, Josh.
Thanks, everyone.
Thanks for staying with us and learning. Bye.